told you that every single economic boom and every gut-wrenching bust could all be traced back to just one thing? Well, today we're diving into R.G. Hawtrey's powerful and pretty controversial theory that claims exactly that. It's all about the money.
I mean, this is the big question in economics, right? Why can't things just be stable? Why do we have these amazing periods of growth followed by these painful recessions? Economists have been chasing the answer for centuries, but Hawtrey was convinced he'd found the master switch.
And there you have it, straight from the man himself. This is the whole idea in a nutshell. Hawtrey is basically saying, look, if you want to understand why the economy goes up and down, forget about innovation, forget about psychology, forget about government spending. You just need to follow the money.
All right, so here's our game plan. First, we'll unpack his really bold claim. Then we'll look under the hood at the engine that supposedly drives this whole cycle. We'll walk through the 4 phases step by step. Then we'll get into the major criticisms, and believe me, there are a few. And finally, we'll figure out what his lasting legacy really is.
Okay, let's get right to the heart of it. What exactly did Hawtrey mean when he called the business cycle a purely monetary phenomenon?
Now, the words to focus on here are sole and sufficient. That is a huge claim. He's not just saying that money is an important factor. He's saying it's the only factor that matters. In his world, the entire economy, all its ups and downs, is just a shadow cast by the expansion and contraction of bank credit. That's it, full stop.
So, if bank credit is the cause, you've got to ask, how does it actually work? Well, Hawtrey's model has a few key players, and one very, very important lever that controls the whole machine. So his whole theory is built on these 4 pillars. First, pretty simple. Demand is just how much money people have to spend. Second, and this is crucial, he puts wholesalers at the absolute center of the story. You know, the middlemen. He says they're the ones to watch. Why? Because they're super sensitive to interest rates since they borrow short-term to finance all the stuff they keep in their warehouses. And finally, the whole system of bank credit is by its very nature unstable.
This is our starting point. Picture the economy in this perfect, beautiful balance. Everything is humming along nicely. But according to Hawtrey, this state is incredibly fragile. Think of it like a pencil, balanced perfectly on its tip. It doesn't take much of a nudge to send it toppling over. And this right here, this is the master switch. The interest rate is everything. When it's low, it's like stepping on the gas. Wholesalers see cheap money and think, great, let's borrow and stock up. When the rate is high, it's like slamming on the brakes. Borrowing is expensive, so they sell off inventory and stop ordering. He argues that through this one simple lever, banks basically control the rhythm of the entire economy.
Okay, so we've got all the pieces. We've got the banks, we've got the wholesalers, and we've got the interest rate lever. Now let's watch how this thing starts moving, creating this powerful, self-generating cycle of boom and bust.
Hawtrey breaks it all down into these 4 distinct phases. And the key thing to remember is that each one logically and automatically leads right into the next, creating a continuous loop driven by nothing but the flow of credit.
So it all kicks off when banks have a lot of cash and they lower interest rates to get people borrowing. Wholesalers see that cheap credit and they pounce, ordering more goods. That sends a signal to factories to ramp up production, which means they hire more people and pay out more in wages. All that new income gets spent, which boosts demand even more. Wholesalers see their stuff flying off the shelves, so they order even more. You see where this is going? It's a positive feedback loop, what Hawtrey called a cumulative expansion.
But you know, no party lasts forever. As the economy is booming, people start pulling more actual cash out of the banks, and this slowly drains the bank's reserves. To protect themselves, the banks have no choice but to slam on the brakes by jacking up interest rates. And what's so important here is that the boom doesn't end because of some big disaster. It ends because the banking system itself simply runs out of gas.
And this is basically the first phase thrown into reverse. Suddenly, those high interest rates make it really expensive for wholesalers to hold on to inventory. They stop ordering new stuff and start desperately trying to sell what they have. So factories cut production, they lay off workers, and people's incomes drop. That creates demand, which forces wholesalers to cut their orders even more. Now you've got a vicious circle of deflation pulling the entire economy down.
But while all this is going on, something quiet is happening in the background. People are paying back their old loans, and that money is flowing back into the banks. Their reserves start to fill up again. Pretty soon, they're sitting on a pile of cash with hardly anyone wanting to borrow. So what do? They have to lower interest rates to attract customers. And just like that, cheap credit looks tempting to the wholesalers again.
and the whole cycle kicks off for another round. It's a pretty elegant theory, isn't it? It's a neat, self-contained little machine. But as soon as Hawtrey laid it all out, other economists started poking at it, and, well, they found some pretty big cracks in this purely monetary world.
This slide really gets to a fundamental disagreement. It's a classic chicken or the egg problem. Hawtrey says the banks raising interest rates is what causes the boom to end. But his critics say, whoa, not so fast. You've got it backward. They argue the crisis happens for other reasons, like maybe profits start to fall, and the high interest rate is just a symptom of the panic that follows, as everyone tries to get their hands on cash. It's a huge difference in perspective.
And the hits keep coming. I mean, what about everything else going on in the economy? Where do things like the invention of the internet fit in, or just general business confidence? Hawtrey's theory doesn't really have a place for those powerful, real factors. And what about this obsession with wholesalers? Critics argued that the real drivers of the economy are big, long-term investments by businesses, not just middlemen deciding how much to stock. And are wholesalers really that sensitive to interest rates anyway? Think about it. If they expect a massive holiday season, a slightly higher borrowing cost probably isn't going to stop them. Future profits often shout way louder than interest rates. And finally, his theory doesn't really explain why every cycle is so different. Why did the Great Depression last so long? Why was the 2008 crisis so unique? A purely monetary theory suggests the cycle should be more or less the same, but reality is a lot messier.
So, where does all this leave us? Is Hawtrey's theory just wrong? Well, not exactly. It might be too simple to explain everything, but it left a really powerful and lasting mark on how we think about the economy. Let's break it down side by side. Hawtrey's genius was showing how a cycle can feed on itself, and how money creates those critical tipping points from boom to bust. And his focus on monetary policy is now totally mainstream. Anytime you hear on the news that the central bank is raising or lowering rates to cool down or stimulate the economy, that is a direct echo of Hawtrey's thinking. His big weakness, though, was his insistence that money was the only thing that mattered, which left his theory looking a little one-dimensional.
In the end, Hawtrey's theory is this fantastic reminder. We all love simple, neat explanations, but they rarely capture the full, messy truth of something as complex as the economy. It kind of forces us to accept that the economy isn't some simple machine we can just fix with one lever. It's a complex, living system that we're all a part of. And maybe, just maybe, understanding all of its interacting parts, the money, the technology, and our own human psychology, is the first real step to navigating its wild and inevitable cycles.